I guess. I'm gonna try to explain this really quick. It's the second half of that first video that I made talking about relative value. I want to explain the investor cycle and what I call the money game. First of all, the investor cycle. It's something that happens with, it can happen with money, it can also happen with stock, but we can look at stocks because it's very apparent. So with stock, here's what happens. Investors are looking for something that's appreciating in value, are they not? Yes, they are, because they're trying to make money off it. They're trying to buy it at a low price, sell it at a high price. So they're looking for something that's appreciating value, going up in value. So they can buy it at that low price and sell it at the high price. So naturally, when that happens, and they see it happening, an appreciating asset, I'll just draw a chart right here. When they see it start to go up, guess what? They like it. They want to come get it. So the demand for it increases, especially with stock, because a stock, it has basically, its demand's basically 100% investor demand for the most part. So stock especially, it's super obvious. And so when it's appreciating, demand increases because all the investors are coming in trying to buy it. Boom, that causes the price, they make offers, so boom, price starts going up. And at the same time, if you're an investor, you're probably gonna hold on to it if it's going up in value because you're just trying to make as much money as you can. So naturally, the available supply is probably gonna go down. There's something called trading volume, and you can see that in the stock market exchange, you know, they track that. And you can watch it and see it, but generally speaking, if it's an appreciating asset, you're probably gonna hold on to it until you feel like you need to get rid of it, you know, until you feel like it's a good time to sell. So naturally, that's the first, I guess, part of the oscillation that is the investor cycle. And so investors looking for appreciating assets, so what do? They look for it. When they see it, boom, they all come jump on it and then, you know, make offers for it, cause the price to go way up. And so that happens, boom, the prices start like going up exponentially. You see this all the time. It happens in the first half of the investor cycle. Second half is at some point it gets really high and investors are like, ooh, I don't know if it's a good idea to throw my money into that. So they don't think it's a good idea. So when that happens, what happens? The investor, well, you know, all the investors are like, yeah, I don't think it's a good idea to buy it at that super high price. I don't think I'm gonna buy it here. It's gonna go up really much higher. So it's really just an unsafe bet to put my money there. And you know, a lot of people at this point, they might call it a bubble. Dude, it's all a bubble if you understand how the stock market works. But yeah, at some point they say, yeah, that doesn't look like a good thing to buy. So they just say, you know what, I'm staying away from it. So really what's happening is the demand for it kind of just starts to disappear. And when that happens, all these, you know, these offers that are being made kind of just disappear. And eventually the price starts to slow down. And when people see, when these people are holding on to it, see the price starting to slow down, they're like, oh crap, let me get rid of it quick. But guess what? These people who have already, the investors have basically already made the decision that it's not a good idea to buy it at that point. So when these people who are holding on to it try to all of a sudden get rid of it, guess what? There's nobody to sell it to. So what happens? They only, you know, they put it on there trying to get the best deal they can. It's going to be lower, lower, lower. The price rapidly drops. And that's the second half of the investor cycle. That's like one oscillation of the investor cycle. And so you could see that would be trading volume. You know, on the upswing, you have everybody holding on to the asset, a low available supply while the demand's increasing. Then at the peak, you have the investor saying, that looks like about, that's as high as I'm gonna go. I ain't gonna buy beyond that. That's just dangerous and silly. If you're a smart investor, you probably sold before that. But if you're stupid, you probably didn't. Anyways, so that's the upswing, decreasing supply because most investors are gonna be holding on to it as long as it's appreciating. Most of them. Of course, people, you know, if you're gonna buy at any point here, that's somebody selling it. So there's trading volume. So there's probably gonna be a smaller trading volume. And then at this point where it gets really, really high, there's usually an increase in the trading volume. Means everybody's trying to dump it all of a sudden. But guess what? These people, all the investors already said, nope, I don't want to buy that. And so they all try to dump it at the same time. That's an increase in the available supply. And the price goes way down because there are no investors trying to buy it. Eventually people will, when the prices start going low enough, investors are like, okay, this is really low. But these investors study charts and stuff, all that stuff. Here's what's really happening. They're going to see it's going low after they've studied the charts and everything. They're like, oh, this is a good grab. Get it while it's low, you know, so you can take part in cycle, you know, number 2 of the investor cycle. You know, the second upswing on the investor cycle. And so when it gets to a certain point, a certain low, they call it a floor, I guess. People will come back in and buy it up, and naturally it'll start appreciating again. Second thing, happens again. All these investors are attracted to it again. Boom, and they try to get in early and sell high. But they, the whole it's all a fucking it's a Ponzi scheme. The whole stock market Ponzi scheme, because if you're gonna buy and sell high, who are you selling to? You sell to some dupe up here. Somebody, it's like a game of hot potato. The longer you hold on to it, the more points you get, the more money you get. But eventually, you want to get rid of it before, the music stops right there. And somebody left. It's called left holding the bag. That's what they call it. Somebody sold to the guy at the peak. That dude was a dummy. He didn't understand none of this. Too bad. He was left holding the bag right before, somebody sold it to him for this really high price. He traded a bunch of money for it at this really high price, and right after, the price just plummeted. That sucks, doesn't it? But that's the name of the game. It's a Ponzi scheme. It's a game of hot potato. You're handing off to the next guy. You're just trying to hold on to as long as possible from this point to that point, make as much money as possible, make as much of a gain, a spread, by buying it this low, selling it this high. But you want to get rid of it before it crashes. A lot of people are conned into doing stuff. I'm just going to talk about stocks a little bit for a second. I'm going to get into what I call the money game in a second. It has everything to do with changing values and everything. And it's pretty much playing this game with other assets, even money in the economy. Whatever your net worth is held in, whatever type of asset your net worth is held in, is basically playing this same game with all those other assets. But I want to talk about stocks for a little bit. A lot of people are conned into jumping into this game without knowing how to play it, without understanding any of this. They're just told, oh, buy Walmart, hold on to it forever. What are they doing? They're just adding to the demand, making the price go up. Somebody, the more that happens, the more options these people who know how to play the game have to sell to. The more options that these people that know it's a game of hot potato have to hand off the hot potato to. Just imagine playing everybody's playing hot potato. You have no idea. Somebody hands you this potato. You think it's just, I don't know. It's not like that, because people at the end of the day, they're buying stocks. If you don't understand this stuff and you're putting your money into it, you're probably not a smart guy. That's actually how I learned a lot of stuff, because I was going to invest in cryptocurrencies, and I was like, I don't want to just throw my money in there because that's stupid. So I really thought about it, and this is where I kind of came to, this is where I discovered the investment. I don't think anybody's discovered this, by the way, before me. I have not heard anybody talk about it. I heard something about the Satoshi cycle, talking about the more people that talk about Bitcoin on the internet, the higher the price goes, but that's nowhere near this whole oscillating thing. This is, I think I found, and then it goes into the money game, which is a whole another aspect of it. And this all came from studying Bitcoin, cryptocurrency, because I was going to invest. I was like, no, I ain't going to waste my money. I'm going to make sure I know what's going on here, make sure I know how to play this game before I jump into it. That's how I learned all this. And, so anyways, a lot of people are duped into playing this game. They're just like, oh, just put your money there. You're gonna make money, dude. It's gonna happen. Da, da, da. And that just gives these people who understand it's a game of hot potato, gives them more options to dump that potato off on, And then eventually somebody trades a whole bunch of money up here at some peak, and you usually don't see it go up higher than the first peak. It's usually because the investor. This has everything to do with investor psychology. If you got burned up here, if people got burned up there, there's no way people are gonna go back up to that price, unless they're crazy. So it usually goes lower. You usually get this run up type thing. You might have a little peak. I don't know. It's different with everyone because there's different news and stuff with every single asset. There's different things. A lot of people are stupid enough to. How do I explain this? I'm talking about stocks a lot here. I'm talking about investing, and a lot of people believe that stocks just go along with company performance. If a company does good, company performance. If a company does good, they think that the stock price goes up. That's not how it works. It's just that people correlate that, with, they think that, so they buy whenever the company does good. And then you see that correlation on the price. The demand increases whenever the company does good. And they're actually causing the price to go up. It has nothing, the company can do whatever it wants. And if people didn't buy on the secondary market and cause the price to go up, nothing would happen to the stock. The stock would do nothing. You know what I mean? It's just people act based on certain information, and you have to understand. You have to understand the strategy of an investor. He's trying to make money, so he's going to try to get in early before the price goes up, and that means he's going to buy. And naturally, when those people buy, they're actually increasing demand, and that's what's happening. So there's a lot of reason to buy. They've seen charts like for like familiar shapes that they've seen. They hear, they know that there's a correlation between the company's performance and the price of stock. Well, that's really caused by them. They might not know that, but they might not. I don't know. And then there's people who just told, oh, here's how you get rich in the stock market. You buy Walmart at this price and wait till it goes up $1,000 million. Guess what? You have to sell it before the music stops. Either way, it's a Ponzi scheme. Eventually, every single stock, it could go on indefinitely. It could, but really, at the end of the day, it's just a piece of paper. They say it's ownership in a company, really. Unless you own like majority shares, then you don't. It's just a piece of paper to you. Unless you're gonna go like, use your voting rights to vote on something. I mean, but really, it's you use Enron as an example. Enron looks something like this. It went like crashed straight down. And Enron was just everybody believed that the company's doing good, so they bought based on company performance. And guess what? The company wasn't really doing anything. It was all just a big freaking Ponzi scheme, exactly what I'm talking about. And so yeah, the price plummeted after everybody found that out. But at the end of the day, I think they call that fundamental analysis. That's the stupidest thing in the world. It's only stupid, well, it only doesn't seem stupid because people buy based on company performance, and then that's reflected in stock price charts. So really, at the end of the day, it's really stupid. It has nothing to do with the price of the stock, except for the fact that people buy based on company performance. It really has everything to do with the investors' decisions. And so that's the investor cycle. That's something you see over and over. And the same thing happens with a stock. Okay, so a stock has 100% investor demand, basically. Everybody who's buying stock is basically trying to make money off it. They're trying to buy early and sell high. That's what they're trying to do. Nobody buys a stock just because they love it. Nobody does that. No. Everybody buys stock trying to make money. That's what they do. So 100% investor demand. There's other things, though, in the economy that have mixed demand, like housing, real estate. People want real estate to house a business, to live in. Okay, but also there's investors who want to buy the real estate at a good price and sell it to somebody else at a higher price. So those are mixed demand, but there's still similar things that happen. There's still bubbles that exist. What's a bubble? A bubble is basically the first half of the investor cycle. It's these investors are attracted to an asset. They're playing a game of hot potato, and the price gets up to some crazy point, and everybody's like, yeah, that's not. I ain't gonna buy that, and all the investors say I ain't gonna buy that. They call it a bubble. But basically, it's just the same thing. It's just part of the investor cycle. It does. It's pretty much a bubble. Dude. If you look at cryptocurrencies have no. And this is how this was another thing that I was thinking about. Cryptocurrencies have no company behind them. Absolutely none. Yet their price went to like crazy, and they're not used as money. It's not like they're really used as money. No, it's all investor demand. Investors bid up the price to some crazy level. Yes, that was a bubble. Yes, I mean they were just literally. It's just a game of hot potato. There's no company, no nothing behind it. Bitcoin went all the way to $20,000, dude. Are you kidding me? There's no company, no nothing. It's a game of hot potato. It's exactly what I'm talking about. And so if you doubt it with anything else, I mean, it's the same thing. The stock, nobody cares about. You're not buying a stock to feel good about owning part of the company. No, unless you're buying a whole freaking company, no. They're buying stock to make money, to sell it later on down the road. That's what they're trying to do. And it's a Ponzi scheme because you're duping it off on somebody, and eventually somebody's going to be left holding the bag. It's a Ponzi scheme. It is. So the same thing happens with other stuff too. Real estate, even with money. When you have money, the same investor cycle happens. There's a certain amount of money. People will trade their stuff for it, and that's why I'm talking about relative value. People will trade their stuff for it, and the same thing could happen. If the price is going up, a lot of people might say, hey, I should save my money until the value goes way up. The same exact thing will happen. And then when it goes up to a high enough point, they say, oh, I should spend my money because it's at a really high relative value. They start spending it, increasing the available supply. You probably won't see as much in money because there's this secondary type of demand for it. If it goes up high enough, people might sell it, or not sell, trade it. And, so you have a contracting supply on the way up because everybody's holding on to it. It's back in their bank accounts or whatever, at home, whatever. and there's still all this demand for it, and also other people might be attracted to it because they see the values going up. They're like, hey, I want to save too. They want to get their hands on it, put it in their little bank accounts and whatnot. So you're gonna get the upswing. Probably you can. It just depends. It's much longer term. Usually, I don't know. The same thing can happen. I'm not saying it does because there's a lot of intricacies involved, especially like it depends. The same exact thing could happen, and just listen, just follow me. So saving money, it's the same thing as buying an asset, holding on to it. Decreasing the available supply might attract other people to do the same, come get their hands on some, which increases demand, causes the value to go up. They hold on to it, further decreasing the supply, so on and so forth. So it gets to our point, everybody's like, look at how much my money's worth, da 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 da. You got them with gold, silver, any asset like that. And when it gets to that point, they might say, hey, it's time to trade it, time to cash in at that really high relative value. When that happens, they increase the supply, which, depending on the other type of demand for it, it could cause a ripple in the value of it, and it would really have. It's not nearly as obvious as it is with 100% investor demand, but the same thing, similar. It could still have a ripple, and it could cause investors, you might say, to say, oh, look, it's going down in value, let's get rid of it real quick, and further increase the supply. Do the same thing, cause the increase in supply, decrease the demand, cause the value to go down. The same thing can happen. So happen with gold, silver, stocks, anything. Happen with real estate too. Real estate, a lot of people might just buy houses and hold on to them, and think that the market's going up and stuff, and it's still the same thing. Investor cycle, it's still happening, and this is what I'm talking about. So the investor cycle is that. The money game that I call it, the money game, is basically your net worth is going to be held in any given portfolio of assets, right? So you want to make sure that your assets are held, that you're never holding on to a depreciating asset. So if you're holding on to this stock, you want to sell it before it goes down. And it's like I'm telling you, it's like a game of hot potatoes, like a game of musical chairs. It's how people have to play. And the more people learn this, the more there's going to be fluctuations going on. And it's just